Coming up in today's review, stocks finish the day lower, a look at seasonality, fourth quarter GDP data, Bitcoin approaches all-time highs, and what stocks could do well if Trump gets back into office. Hey, what's up guys, it's Jared here. Thanks for tuning in today. And just looking at the action we got here today, even though it was a pretty quiet day for the stock indices, still coiling up on low volatility going into tomorrow's PCE data. We've got some interesting moves out there happening and a bit of a divergence today in risk on assets. So you can see looking at breadth, it was quite checkered across the board. A little bit bullish in financials and industrials. However, we did see semiconductors come off a little bit along with tech in general. We can see that looking at the big tech stocks, Apple down, Alphabet the biggest loser, NVDA coming off a bit, along with these other hot stocks, ARM and Super Microcomputer. However, stealing the show today is Bitcoin, briefly hitting 64,000 right on the nose and just taking you out to a weekly chart. That's now smack bang and there's big resistance zone. First formed since April 2021, then when we made the all-time high in November 21 at 69,000. And that's to the pleasure of all those large Wall Street asset managers launching new Bitcoin ETFs onto the market a little over a month ago. And at last count, they'd pulled in over 16 billion in assets. That's probably gone over 20 billion today. And including what's already in Grayscale's Bitcoin Trust, which is still the biggest, there's more than 40 billion in total in Bitcoin ETFs. And so there's three good reasons why we're seeing a big rip in Bitcoin. One is basic demand and supply, as Bitcoin ETFs are doing a lot of buying of the underlying. In fact, 10 times more than what's being produced from Bitcoin miners on a daily basis. The next is excitement going into Bitcoin halving, which is set to happen on April 19, a bit over 6 weeks away, and basically that happens every 4 years. And what that means is the amount of new Bitcoin that can get mined each day gets cut in half, so further reducing the supply. And that's often a time when Bitcoin can do well, as the market likes to front run that reduced supply. The third reason is good old momentum, optimism, sentiment, and liquidity that spilled over from the AI rally, and it all feeds onto itself. That's why we're seeing record high trading volume and participation in the market in these new Bitcoin ETFs like the iShares Bitcoin Trust, doing a huge 95 million units today. That's more than 4 times the average daily volume we've seen so far. Same deal in the second largest Bitcoin ETF. The Fidelity Bitcoin Fund, clocking in just under 27 million units traded. And it's no surprise we've got Wall Street jumping on board. Seen articles like this, MicroStrategy stock has big upside, as MicroStrategy is pretty much a Bitcoin ETF itself. Its underlying business is flat. They're the largest corporate holder of Bitcoin with 193,000 coins and an average price around 35,000 a coin that they have bought in. Market could also be getting excited on the back of the early success of Bitcoin ETFs that Ethereum will be next. And that's showing up in the most traded list today, with Marathon Digital coming in 7th most traded stock, Coinbase number 8, and MicroStrategy in the top 15 as well. Same deal in the options market, MicroStrategy 5th most traded today, really lopsided calls to puts. Same with Coinbase and Marathon. There's a look at MicroStrategy. Huge volume today, big spinning doji, which sets up for potential island reversal. That's a chart pattern when you see a gap up, candle like this, and if we were to gap down tomorrow, then that creates an island. But even though we got Bitcoin ripping today, we didn't see Marathon rip. It actually only finished 2.3% higher, and we just got earnings from it, and it looks like we're selling down as I speak, 6.5%. Same deal with Coinbase. Only finished the regular session up less than 1%, selling a little bit off after hours here. And they had an outage today. Customers seen zero balance in their account. So there we are with Bitcoin trading live as I speak, 60,500 a coin. And just going down to a 1 hour chart, I'm reluctant to call a top on this because there is so much momentum and those fundamental drivers of all that demand coming into the ETFs, going into halving. Overall risk assets have been on a roll for a couple of months. However, just looking at this 1 hour chart and the volumes we got today, that can indicate a potential top here, or that we could be approaching a top, which like I showed you on the weekly chart, 69,000. So the way this is going, it could easily hit that tomorrow. We could hit 70,000 tomorrow. And like I said, we didn't see all these other risk assets, these other hot stocks, NVIDIA, ARM, Super Micro, and a few others actually came off today a bit. And just looking at Bitcoin itself, I can see it's 37% above the 50-day VWAP, which is also at its record overbought extreme here. However, the whole thing with Bitcoin and what all the whales and hodlers love about it is its finite supply. There'll only ever be 21 million mined Bitcoins, with the last halving event in 2149. So the whole thing's a pile-on. Who can corner the most Bitcoins? It'll never be used as a global currency. Governments just simply won't allow it. And why would you use it to go and buy your milk and bread if it's just going to keep going up in value? The whole thing is just holding it and holding it. So it very well could hit $1 million and be the most epic bubble of our lifetimes, even potentially all of financial markets history. That's why I said I'm reluctant to call a top. However, days like today, we may even be close to a short-term top, or if we keep going up from here on bigger volumes, bigger moves, then this truly is the mother of all speculative bubbles. And whilst I'm not a big crypto holder myself, I do believe in blockchain technology and how it keeps traditional finance honest and on their toes, help to improve transaction processing speeds, and given some healthy competition. To all the banks out there, I like that part of it. However, it's just almost impossible to value because there is no yield. Some people say it's a currency, other people say it's an asset, but the whole thing's pretty much based on the perception of its value and more people buying it and holding it and just kind of cornering it. And so there's really no telling how high it could go. And the fact that it doesn't really have any intrinsic value doesn't really matter at the end of the day. But nonetheless, as a financial observer, it is very interesting to watch, to say the least. So we will be keeping an eye on it, and with how these new crypto ETFs evolve in financial markets. Moving on to the stock market, which we mostly follow on this channel, and just looking at seasonality coming into February. Like I was saying at the start of this month, there was a lot of people bearish out there. We could all see we were due for some weak seasonality in February, just looking at election year seasonal patterns. And the green line here, which tracks a sitting president running cycle, normally would peak out early mid-February, then roll over into mid-late March. However, with so many people expecting that, and even though we had to have a bit of a pullback year to date underneath the surface, the main indices have just kept ripping higher, and we're already tracking well ahead, up more than 6% compared to previous presidential election years. However, if seasonals do play out, then there could be some weakness going into March, April, but maybe only after the market's convinced most people that that's not going to happen, that it will happen. And according to some historical data, this stock market is only 50% through its current rally. That's coming out of Ned Davis research, who said when considering the average length of a secular bull market, the current rally could last another few years. With the current bull market in stocks only 344 trading days old, and the average length of a bull market 694 days. And that's based on a chart that measures the length of time the S&P goes without a 20% decline, which, like all measures of bulls and bear markets, is pretty arbitrary just to pick these numbers, but it is one way to put it into context. And we can see down here the chart of the number of days without a 20% correction, currently at 344, which is pretty low compared to the average and some lengths of other bull markets like the 90s, which went a bit over 3,000 days, and then the 2010s, which went over 2,500 trading days without a 20% pullback. And it isn't just all tech stocks. We are getting a little bit of broadening of the bull market, picking up in participation. Like I showed you guys yesterday, we've got international stock markets trading pretty well, coming off good valuations. And one sector not many people talk about, but is actually also leading this market, is industrials. And industrials are considered cyclical stocks, up and down with the economy. And looking at the price action in stocks like Caterpillar and the industrials ETF breaking out, that's more in line with an early stage bull market, as we've got some of the defensive sectors like utilities still kind of weak and pulling back. So overall in the medium term, there's no real rotation into those defensive sectors. We can see that in the monthly chart of industrials breaking out to all-time highs, along with key components of that sector like Caterpillar trading up really strong as well. And then just looking at the monthly chart of utilities, a defensive sector still well off its highs from 2022, when there was a bit of a rotation into there out of those high growth stocks. And one could argue that they're still in a bit of a bear market here, sideways at least. Although consumer staples are looking a little better and healthcare is actually breaking out. We've also got transports close to breaking out to all-time highs. Financials close as well, and energy just still consolidating there, with the obvious big leaders being semiconductors, technology stocks, and home builders. And in some ways you can draw comparisons to the current tech run to that of the late 90s. However, there's also some other research that says that today's bull market is not a dot-com bubble remake, as there are some key differences. That's one analyst who says in 1999, the Fed was loosening policy, effectively injecting liquidity into the rally, but that today's valuations are instead supported by quality earnings and record free cash flow, which is no doubt true. The big mega cap tech stocks are big cash cows. He did admit that it is true from a technical point of view, the positioning of investors looks stretched and pockets of US equity market are reaching overbought territory. But he did point out key differences, that back in 99, the Fed eased rates by 75 basis points in response to the Asian currency devaluation crisis. In turn, that spurred the dot-com spike, providing markets with an ample liquidity injection. In comparison, today's rally follows on the back of the most aggressive tightening campaign in the Fed's history and is not the result of excessive money supply. So I guess that argument holds up as long as earnings hold up, or at least growth, because if we were to see growth in some of these mega cap tech stocks, like Apple already has plateau, then that could plateau the whole market and potentially lead to a correction and a bit more of a spillover. But for now, we're going to keep getting headlines like this: why investors should buy into an egregiously expensive stock market. Research coming out of BOA, who said the stock market may be expensive based on traditional measures, but that doesn't mean investors should avoid stocks. With them going on to say comparing present valuations to the past is comparing apples to oranges, as the S&P is half as levered, higher quality, and has lower earnings volatility than prior decades. And there are some pockets of the market that are outperforming the S&P 500, like an ETF that tracks the stock trades of Democrats in Congress. It's been beating the market, and the Democratic ETF, with the appropriate ticker symbol, Nancy, in a nod to former House Speaker Nancy Pelosi, has surged 30% since its launch a little over a year ago, compared to the 24% gain for the S&P 500 over that same period of time, which is a pretty good outperformance for a diversified ETF just in that period of time. And you got to remember with ETFs, they can't follow anybody exactly to the T. There's always a lag, plus ETFs have a bit of slippage getting in and out of positions. So the fact that it's been able to outperform by more than 30% of the S&P's return in a year, pretty good job. And there's a look at the weekly chart of Nancy, and actually starting to pick up on a lot of volume this year. And so it should come as no surprise that there is alpha to be found in following the trades from Congress members like Nancy Pelosi, as governments are the biggest influence on markets, and obviously they have great oversight and influence on the outcomes of key industries that they invest in. And you know we're in a bull market when we see IPOs picking up. We've got Reddit coming onto the market. Now we've got the popular brokerage Webull planning to go public via a SPAC. With estimates it's going to be valued around $7 billion. And just like Reddit, they've done a great job timing their launch onto public markets. And we can see this in the IPO ETF starting to break out to highs. But just going out to a weekly chart, still well off its all-time highs reached in early 2021 after it had a huge rip out of the COVID lows. But just looking under the hood of stocks it owns that have IPO'd in the last couple of years, a lot of them are still well off highs after they got smashed down in 2022. On the other side of the coin, we've got one strategist saying stocks are primed for a 10% correction because the current rally isn't broad enough. That's Piper Sandler's Craig Johnson, saying the S&P could trade down to 4,500, and that could happen as soon as next month. With him saying, you can see that after the big runoff from the October 23 lows, we're now pressing to the upper end of the very well-established 18-month price channel, and that this is not where you start the next leg up. You don't do that at the end of the channel, technically speaking. With them also going on to say the breadth of the market has been steadily contracting throughout all of 2024, and like oftentimes in history, the move in breadth can precede the move in the overall market. We also got a list of potentially big surprises we could see this year from investment bank UBS, with them saying China's GDP could slow to 3% rather than accelerate, the yield curve could steepen to 2%, and a candidate other than Joe Biden or Donald Trump ends up winning the November election. No real surprise they say AI could fuel a massive stock surge. They also predict we could see peace in Ukraine, which would help Europe, especially Germany, if that translated into lower energy prices. They also said Apple's market cap could tumble based on a mature smartphone cycle, no real obvious AI strategy, and already weak earnings and growth. However, when it comes to the US presidential election this year, pretty much just looks like a showdown between Trump and Biden, and more by the week, Trump is looking like a shoo-in. With the odds from all bookmakers, sports betting sites, got Trump a clear favourite now, priced in almost 51% probability he will get back into office. And so regardless of politics, and just thinking as investors what that could mean for the market if that were to happen, that could have some pretty big effects on some certain sectors out there, with some analysts predicting that could lead to US stocks continuing their outperformance of international peers. And Trump, a big China hawk, could translate into more struggles for the Chinese stock market if he pulls America further away from China. And America's already importing more goods from Mexico than it is from China at present day. Trump's not big on clean energy, so that sector could continue to struggle, and maybe why it already is struggling. The market may be pricing in that. Defense stocks would likely thrive. Trump's big on building a strong American military, and also bank stocks could also benefit from another Trump presidency. As like his first term, he looked to loosen the Dodd-Frank rules, ease up capital requirements, allow banks to take on a little more risk, and overall, he's viewed by a lot of people as being quite business friendly. And the US economy is already holding up pretty well. We just saw that again today, with the revised fourth quarter GDP only slightly downgraded from 3.3 to 3.2%, still pretty healthy growth, considering the rate environment that we've been in for 18 months now. So that did result in a little bit of a downtick in Treasury bond yields, but just like the stock market, bonds are pretty quiet going into the big print tomorrow PCE. Personal consumption expenditures. Looking at personal income and spending, that's the Fed's preferred measure of inflation, with the market eager to see that continue to come down. However, economists are forecasting to show a 0.3% increase in January, marking the largest gain in 4 months. And the core PCE price index year over year expected to come in at 2.8%. So looking at the 2-year yield, just pulled back a bit there today, 464. Bond prices consolidating as well, looking at TLT. And interesting today, got a little bit of a bump up in the VIX, maybe pricing in a bit of movement tomorrow, even though the markets didn't really come off too hard today. But overall, option deals are pretty chill, not asking much in the way of premium above realized volatility here. So it really would be a surprise to markets if we got a hot print tomorrow. As right now, option markets are pricing in as if we're not going to get anything out of the ordinary. And just looking at Fed fund futures, pulled back probabilities a little bit that the Fed will stay on hold in June. Still given about a 63% chance that they'll cut come mid-year, and we'll see how these odds change after we get PCE tomorrow. No surprise, the fear and greed index still really elevated here, and what must be approaching a record length of time we've stayed in the greed and extreme greed zone. But once again, contrasting that, it's the big jaws gap in corporate insiders doing plenty of selling versus buying, taking advantage of these elevated prices. And just looking at some breadth here, the weekly chart of NYSE new highs, it is holding up. It's not really breaking out like we saw in mid-late 2020. Same deal with NASDAQ issues. There are more new highs than new lows, but no real big steady uptrend there. There's a look at the dollar index, bouncing a little bit here today. Latest look at the hourly chart of Bitcoin as I speak, it's holding ground above 61,000 here. We may come up and retest these highs, and who knows, even have a go at all-time highs above 70,000 in the coming days. But like I said here, this candle is what you see sometimes at a top big doji candle on huge volume that most often gets retested, at least to the midpoint, sometimes close to that high. But there are just some really strong underlying factors, like all the people piling in to these new Bitcoin ETFs, and just looking at the hourly chart of IBIT, it too put in a little bit of a topping formation on this shooting star candle right here. So it's going to be really interesting to see how this trades going into the weekend. Crude oil just snuck out to multi-month highs today, almost touching $80 a barrel before pulling back a little bit here. Bit of a pullback in Chinese securities today from the short-term overbought level, and more worries in their property sector. This bottoming process in their market is going to be a messy one to say the least. There's clean energy as well, still trading down near lows. International stock indices all came off in Wednesday's session. Semiconductors was actually one of the weakest sectors today, and like I said, some of these hot AI stocks didn't put in the same performance as crypto today. See that in Big Bear AI after it exploded up the last 2 days. Actually pulled back a bit here today. Same with Carvana. He had a huge rip in Beyond Meat, stock that had been left for dead. After, even though they came in with worse than expected numbers, they improved their margins, market gapped them up. But just looking at a monthly chart, I'm sure some of you remember back when it came on in 2019, it was the hottest thing. There's a lot of people convinced plant-based meat is going to overtake traditional meat. However, their sales have actually fallen in the last couple of years, as a lot of people are skeptical on what's actually in the product. It's much more expensive than traditional meat, and a lot of people are not really convinced. And at the end of the day, most people won't pay extra to save the environment. People will buy the cheapest product that suits them best. And so who knows, maybe in the future there's plant-based meat. They may just be, who knows, 10, 20, 30 years too early. But this one is a funny one. Not sure whether they'll survive the next couple of years if they keep losing all this money. Another interesting chart for you is the Israel ETF, ISRA. Pretty thinly traded. Initially sold off really hard after the outbreak in the war between Hamas and Israel. However, it's found a bottom and it's actually trading higher than where it was right before that. Same with the Saudi Arabia stock market. That sold off into that conflict, but it's had a pretty good bounce since then. Another stock sneaking high like General Motors, but still yet to be seen what happens with New York Community Bancorp and a few other of these regionals. Still not looking that great on the charts here, but JP Morgan still hovering at all-time highs. All right, guys, there we are, coiling up another low range day. Going into PCE data tomorrow, we may see an uncoiling in either direction. Could rip up to new all-time highs if inflation data comes in better than expected or even in line with what's expected. However, if it were hot, then we could see that first 2-3% down day that we haven't seen in a while. Get things really moving here. And of course, there's Mr. Risk Sediment himself, Bitcoin. Juices are flowing in this one. No doubt that's going to be another big day of trading tomorrow. We'll be keeping an eye on that one. And so make sure you come back to the Click Capital YouTube channel tomorrow. I'm going to dive into PCE data, the market's reaction, and I'll show you guys what's moving out there along with my analysis and thoughts on it all. Thanks very much for tuning in today. Appreciate all your support, and I'll see you again tomorrow night. Cheers.